So I want you to picture something for a second. Imagine you are trying to build this like state-of-the-art rocket ship.
Okay, a massive engineering challenge right off the bat.
Right. And you've got the brilliant engineers, you've got the precise blueprints, you're literally, tightening the bolts on the fuselage.
Yeah.
But while you are doing all of this incredibly complex, delicate work, there is someone standing right behind you, actively draining your bank account with a siphon.
Oh, man. Just taking all the cash.
Exactly. Every single second you spend building and testing, your financial oxygen is just bleeding away. And that is the exact situation inside Virgin Galactic right now.
It really is. We're looking at a comprehensive equity research report on them from August 2026, and it is an incredibly tense document to read through.
Yeah, Virgin Galactic, ticker SPCE.
Right. It really sets the stage for this high-stakes corporate drama where the engineering challenges might actually be the easy part.
Compared to the financial reality.
Yeah.
So the mission for our deep dive today is to really answer a single, incredibly high-stakes question. Is Virgin Galactic currently caught in this, terminal, inescapable death spiral of cash burn? Or are we actually looking at the launch pad for a massive, gravity-defying turnaround?
And to answer that, we really need to set the tone right out of the gate here. Because when you bring up Virgin Galactic or, really any commercial aerospace company, it is so easy to get swept up in the romance of it all.
Oh, for sure. Space tourism, it captures the imagination.
Right. It's science fiction brought to life.
Right.
But the actual survival of this company over the next, say, 12 to 18 months,
Yeah.
it has absolutely nothing to do with the romance of touching the stars. It comes down to cold, hard, and frankly, brutal financial math.
Well, okay, let's unpack that math then, because before we can talk about rockets and suborbital flights and all that, we have to examine the fuel that actually keeps a business alive here on Earth. Cash, exactly. Looking at the Q1 2026 numbers in our report, my main takeaway is that they are essentially pre-revenue. I mean, they are making absolute pennies while spending millions upon millions.
Precisely. If we look at the raw data for Q1, they pulled in just $0.2 million.
Wait, $200,000, that's it?
That's it. And that is actually down from $0.5 million year over year.
Wow.
Yeah. And the report makes it clear that this tiny trickle of revenue, it isn't even from flying people to space yet. It's mostly from access fees.
Right, so they are basically charging aspiring astronauts for the privilege of, waiting in line.
Exactly. And to understand the scale of the problem here, just look at their gross margin over the trailing 12 months. It is a negative 6,127%.
Negative 6,000%. I don't even know how to conceptualize that.
Think about what that actually means mechanically, right? Maintaining spaceports, paying elite aerospace engineers, securing highly specialized materials.
Right, those are huge fixed costs.
Exactly. They happen whether you fly 0 people or 100 people. You're essentially carrying the operating costs of a small nation's space program, but generating almost zero income to offset it.
I mean, I will say there is a tiny sliver of a silver lining in the report if you squint really hard.
Okay, let's hear it.
Management is clearly aware of the crisis. They're actively cutting costs, right? It looks like their net loss actually narrowed compared to last year.
It did, yeah. Their operating expenses fell from $89 million down to $66 million.
Okay, so that's something.
So the net loss narrowed to $65 million, down from $84 million a year ago. Management is, frantically pulling whatever levers they have to conserve cash.
But, imagine trying to heat a massive mansion during a blizzard by chopping up and burning your own furniture.
That's a great way to put it.
Right. You are technically reducing your future heating expenses, but you're doing it from an extremely high base against an income that is effectively zero. At a certain point, you just run out of chairs?
You do. And that brings us to the critical math problem management is facing right now. The forward-looking guidance for Q2 2026 is projecting a free cash flow burn of somewhere between $87 million and $92 million.
Which is just a staggering amount of capital to set on fire every 90 days.
Yeah. And if we connect this quarterly burn rate to the bigger picture, their balance sheet, the reality becomes very stark. As of March 31st, 2026, they only had $251 million in cash and equivalents sitting in the bank.
Yeah, that is the number that jumped off the page for me. If you have $250 million in the bank and you are burning roughly $90 million a quarter,
you have less than 3/4 of runway left.
Exactly. Before the bank account hits zero, the clock isn't just ticking, it's sounding a siren. So how are they physically keeping the lights on right now? If the bank account is draining that fast, where's the emergency cash coming from?
They are surviving through a mechanism the financial industry calls at-the-market offerings, or ATMs.
Okay, explain that for us.
Essentially, this allows the company to slowly, quietly drip new shares of stock into the open market during regular trading hours to raise cash.
So they aren't going to a bank for a loan. They're just printing more stock and selling it to retail investors and institutions on the open market.
Correct. They raised $11 million this way in Q1.
Hmm.
Then, as the cash got tighter, they raised another $52 million in April.
Wow.
And just recently, on July 17th, 2026, they filed a mixed shelf offering. This is basically a regulatory green light that tells the market, hey, we're going to need to sell even more shares down the line.
They are surviving by continuously going back to the well, which in this case is the public shareholder.
Exactly.
But that cash burn creates a secondary, much more toxic problem, doesn't it? I mean, if you're bleeding $90 million a quarter on engineering and spaceports, you don't have the free cash to pay back the people who loaned you money years ago.
Right, which forces management to do something that absolutely punishes those same current shareholders.
Yeah, I'm referring to their debt obligations. When a company doesn't have the cash to pay its creditors, they often execute what are called debt-for-equity swaps.
Right. Instead of paying a lender back with dollars from your bank account, you pay them by printing brand new stock and handing it over.
And the report notes they redeemed $10 million of debt this way in April 2026.
Yeah.
But then in June, they filed to redeem up to $30.5 million in first lien notes using the exact same strategy.
And we really have to look at the market's reaction to that June filing because it was violent. The stock price instantly crashed 38% on the news.
Wait, 38% in a single day?
Yep, in one day.
I mean, I know issuing new stock is generally bad news, but a nearly 40% drop just from announcing they were paying debt with stock? That seems catastrophic. Why did the market panic that severely?
Because institutional investors understand the mechanics of what happens next. A 38% drop isn't just an emotional reaction, it's a mathematical recalibration of ownership.
Okay, how so?
When institutions see that debt-for-equity swap, their risk models force them to sell, which accelerates the drop. And it's important to understand the shadow looming ahead here.
It's a future debt.
Right. Even after these maneuvers, they still owe $20.4 million by September 2026, another $10.1 million by the end of 2027, and the massive one, $202 million remaining on notes due in December 2028.
Okay, I have to challenge this entire strategy then. If you issue shares to pay off $30 million in debt and the mere announcement of that causes your stock price to crash 38%, doesn't that mean the actual value of your stock is now significantly lower? So the next time you have to pay a creditor, say that $20 million due in September, you have to issue drastically more shares to hit the exact same dollar amount.
Yes, exactly.
Which will just crash the stock again. I mean, isn't that just a financial doom loop?
You've just perfectly described the mechanics of a dilution spiral. It is arguably the most dangerous dynamic in equity markets.
It sounds terrifying.
Think of it this way. When a company's stock price falls, their fundamental cost of capital goes up. If Virgin Galactic needs to raise $10 million to pay a debt, and their stock is trading at $10 a share, they only need to create 1 million new shares.
Simple math, yeah.
But if the stock crashes to $2 a share, they suddenly have to create 5 million new shares to raise that exact same $10 million.
So to step away from the old pie analogies, if you own 1% of this company and they are forced to double the outstanding shares just to pay off debt, you suddenly own 0.5%.
Exactly right.
Your fundamental claim on any future profits or even your voting power just got cut in half overnight.
Precisely. The dilution becomes a self-fulfilling prophecy. Every time management tries to dig themselves out of the hole, the shovel gets heavier.
Wow.
And what the equity research report emphasizes is that this risk of a full-blown dilution spiral is currently only partially priced in by the market.
Really? Only partially?
Yeah. That July shelf offering we talked about, it creates a massive lingering overhang. Investors know that dilution is coming to pay that December 2028 debt. They just don't know exactly when the floodgates will open.
Now, you can't talk about a shrinking piece of the pie without looking at the baker across the street who just built a massive, fully automated factory.
Oh, absolutely.
Because it is hard enough to fix your own financial house when you're caught in a dilution spiral. But the situation becomes genuinely dire when a massively capitalized competitor sets up shop right next door.
And this report highlights the SpaceX IPO as a major factor here.
Yeah, let's get into that.
It is the unavoidable elephant in the room for the entire commercial space industry. According to the August 2026 data we are looking at, SpaceX just completed its IPO and posted its first public earnings on August 1st.
And the market reaction for Virgin Galactic was swift and brutal. The stock plummeted 32% directly following the news of the SpaceX IPO.
Yeah, that's a huge hit.
Let me put this in perspective for you. Imagine you are running a highly experimental, incredibly expensive lemonade stand. You're constantly running out of lemons, you're taking out loans just to buy paper cups, and your margins are a disaster.
Right.
And then a newly public, highly capitalized, fully operational Starbucks opens directly across the street. The contrast is absolutely blinding for any investor choosing where to put their money.
That contrast in operational maturity is exactly what the market is reacting to. Let's look at how the market is valuing Virgin Galactic right now compared to that. Their price-to-sales ratio, or PS ratio, is sitting at an astronomical 319.2.
Wait, unpack that for a second. 319. What does a normal price-to-sales ratio look like for a company like this?
Well, to give you a baseline, a traditional established aerospace and defense company might trade at 1 to 3 times their sales.
Okay, 1 to 3.
Even a hyper-growth, highly speculative software company might trade at 10 or 15 times sales. Virgin Galactic trading at 319 times sales means investors are paying $319 for every single dollar of revenue the company currently generates.
And as we established earlier, that revenue is almost entirely just those waitlist fees. They aren't even flying commercial volume yet. That is an absurd premium for a company with no operational scale.
Right. And now, investors can look at a publicly traded SpaceX, which operates at an incredible orbital scale, generates massive real-world revenue through government and private contracts, and is deeply capitalized.
It's a completely different league.
It forces us to talk about competitive moats. A moat is a company's structural ability to maintain a competitive advantage and protect its long-term viability.
Yeah.
In the commercial spaceflight market, the barriers to entry, the capital requirements, and the execution risks, they are immense.
So in the aerospace industry, your moat isn't just your technology. Your moat is effectively your access to massive amounts of capital and proven operational scale. If Virgin Galactic's cost of capital is skyrocketing because of this dilution spiral, how do they compete with a company that has practically unlimited capital?
They struggle immensely, which is what the research report points out. Virgin Galactic's lack of revenue, their constant need to dilute shareholders just to survive, and their delayed suborbital operations. All of this severely weakens their competitive standing against a juggernaut.
So the market is looking at the two companies and seeing a glaring relative disadvantage for Virgin Galactic.
Definitely.
So let's look at the actual stock price. We've got a dilution doom loop, a terrifyingly low cash runway of less than 3 quarters, and a competitor that just went public and casts a shadow over the whole sector.
Right. It looks incredibly bleak.
Logically, you would think the stock is just flatlining, dead in the water. But the price action in the report tells a completely different story. It's a wild, volatile tug of war.
The daily volatility is incredible to watch. When this data was pulled, the stock was trading around $3.10, actually up almost 6% on the day.
Up 6%.
Yeah. But if you zoom out slightly, it is down 65.2% from its 52-week high of $8.90, which it hit just a few months prior in early June.
So imagine you're holding SPCE stock right now. You are watching these two massive forces pull the rope in opposite directions.
The bulls and the bears.
Exactly. On the bullish side, the people betting the stock goes up, we actually have some really surprising clues. Insiders, the executives and board members who actually know what's going on behind closed doors, they net bought 176,161 shares over the past 90 days.
That's a significant chunk.
Right. And then there's a whale alert. Rich Wong's firm, Rich Capital, took a massive 5.3% stake in the company.
And that institutional buy-in is largely what drove that massive spike up to nearly $9 in June.
But then you have to look at the other side of the rope, the bears.
The short sellers.
The short interest, meaning the percentage of shares being actively borrowed and sold by investors who only profit if the stock falls, is sitting between 22% and 28% of the publicly available shares.
That is a massive amount of negative sentiment. A normal, healthy company might have a short interest of 3 to 5%.
So why is a 28% short interest actually a terrifying double-edged sword?
Well, it creates a highly unstable, explosive equilibrium. On one hand, 28% short interest means that highly informed, sophisticated hedge funds have looked at the exact same cash burn, the dilution spiral, and the SpaceX competition. And they are betting tens of millions of dollars that Virgin Galactic will fail.
They see the math and they think bankruptcy or massive devaluation is just inevitable.
Exactly. But on the other hand...
It creates the exact thermodynamic conditions for a violent short squeeze.
Yes.
Because when you short a stock, your potential losses are technically infinite if the price goes up.
Right. So if Virgin Galactic suddenly drops a piece of undeniably good news, those short sellers start taking losses.
And if the price rises enough, their brokers issue margin calls forcing them to buy shares immediately to cover their losing bets.
And that forced buying drives the price up higher, which forces more short sellers to buy, creating this massive upward feedback loop. It can shoot the stock price up like a rocket.
No pun intended.
But no pun intended. And it is very likely that a mini short squeeze is what happened during that June rally when Rich Capital bought in.
But I had to push back on those bullish clues for a second. We see insiders buying 176,000 shares. Sure, on paper, that sounds nice.
Right.
But are those insiders buying because they genuinely believe a massive turnaround is imminent? Or is that purchase just a tiny drop in the bucket, maybe a mandated PR move to project confidence, compared to the millions and millions of shares being forced onto regular shareholders through those ATM offerings and debt swaps?
It's a very valid skepticism, and the report actually addresses it. Insider buying is traditionally viewed as a strong signal. The old Wall Street adage is that insiders sell for many reasons, buying a house, paying taxes, but they only buy for one reason. They think the price will go up.
Sure.
However, the report explicitly notes that this insider buying must be weighed against the structural dilution. Going back to your earlier point about the shrinking pie, if executives are buying a few crumbs while simultaneously printing millions of new slices to pay off debt, the fundamental value of your slice is still eroding.
Okay, so we have the ultimate standoff here. The bears are pointing to the rapidly draining bank account and the looming debt. The bulls are pointing to the potential for an explosive short squeeze and insider confidence.
Everything hinges on what happens next.
Exactly. Which brings us to the make-or-break catalysts. What is the single frayed thread keeping Virgin Galactic's hopes alive right now?
It all comes down to the engineering timeline. The ultimate catalyst laid out in the equity report is the new spaceship.
Right.
Ground testing is currently underway. But the absolute make-or-break moment is actual flight testing, which management expects to commence in Q3 2026.
And if that works, commercial spaceflight operations are targeted for Q4 2026, meaning they finally start flying those future astronauts who have been paying access fees, and they start generating real, scalable revenue.
Exactly. The equity research report gives the stock an overall rating of 3, which is firmly bearish.
Okay.
The path to an upgrade, moving to a neutral rating of 5 or 6, is incredibly narrow. They need confirmed, entirely successful flight testing in Q3 and a clear, mathematically sound plan for scaling commercial revenue in Q4.
So put yourself in the shoes of an investor right now. The share price is around $3.10. That is still notably above the 52-week low of $2.13. Is the market currently pricing in a perfect Q3 execution?
It seems like it.
Because if they are, aren't investors essentially walking a tightrope without a net?
They are absolutely without a net. This is what analysts call extreme binary risk. The upside of a successful test flight might be a massive short squeeze, an influx of capital, and a total re-rating of the stock.
But the downside is a literal abyss.
Yes. Virgin Galactic has a well-documented history of timeline delays. Think about the mechanics of aerospace engineering. If a software company finds a bug, they push a patch over the weekend.
Right.
If an aerospace company finds a microfracture during ground testing, that is a 6-month delay.
And a 6-month delay means another $180 million burn.
Exactly. If there is a single delay in the Q3 flight testing, or heaven forbid, a test failure, it would accelerate the cash runway depletion.
They would have to delay commercial operations, meaning no revenue.
Right, and they would burn through their remaining $250 million even faster, forcing them into a much more aggressive, destructive dilution spiral just to survive into 2027.
It all ties back together perfectly. The engineering dictates the timeline dictates the cash burn dictates the dilution, and the dilution dictates the stock price.
And this is exactly why the research report maintains a bearish stance. The turnaround path technically exists, but it requires absolute flawless execution on a highly complex aerospace engineering project on a very compressed timeline while the bank account flashes red.
So this isn't just a story about the future of space tourism. What we are looking at is a textbook, almost painfully clear financial case study.
It really is.
It is a high-risk turnaround racing against a rapidly depleting bank account.
It perfectly illustrates how even the most futuristic, visionary companies, companies trying to literally touch the stars, are ultimately tethered to the harsh, unforgiving gravity of free cash flow, debt maturities, and fierce, better-funded competition.
You can have the best rocket in the world, but if the siphon drains the bank account before you reach orbit, you still crash.
Yeah, that's the harsh truth.
But it leaves me with this one lingering, provocative thought, something the report doesn't explicitly answer, but that we have to ask ourselves.
What's that?
Let's assume space tourism inevitably becomes dominated by established, heavily capitalized giants like SpaceX. What happens to the early pioneers?
The ones who proved it was possible.
Exactly. The ones who captured the public's imagination but just couldn't make the financial math work. Does a company like Virgin Galactic just become a forgotten footnote in aerospace history, a cautionary tale about cash burn? Or if they pull off this Q3 test flawlessly and that 28% short interest triggers a squeeze, could this be the setup for the ultimate gravity-defying underdog comeback story of the decade?
That is the multi-million-dollar question right there.
Yeah.
And the answer won't be found in a spreadsheet. It will be decided in the skies and on the balance sheets over the next few months.
Well, keep your eyes on the Q3 launchpad. We'll see you next time.